Coming up on the SBS on the Money Markets podcast, the US economy expands more than expected. The US share market hits a record here, though. The Santa rally is on pause. We'll tell you why next. Hi, everyone. Welcome to the SBS on the Money podcast for this Wednesday, the 24th of December, 2025, a day where the Australian share market fell, putting to end for now the Santa rally. The S&P ASX 200 off by 0.4%, 8,762. Remember, on Christmas Eve, the market closes around 2 hours early, so the market down today. Of the 11 sectors on the ASX 200, 10 finished in the red. The only one that finished positively was the materials sector, up by about 0.4%, and that's as a number of materials hit record levels. So gold prices hitting a record level today, silver hitting a record, copper a record today too, along with platinum. So what does that all mean for the market? Well, for that and more, I spoke with Mathan Somasundram, the CEO of Deep Data Analytics. So, Mathan, it would appear the Santa rally has taken a bit of a pause on the local share market, but is it really surprising since we've seen such a solid run-up over the past few sessions?
Yeah, I mean, we've had a pretty good run. The Santa rally is mainly for the US market because the global funds and US funds, for them, the financial year end is December. For us, it's June. So a lot of those funds tend to window dress their markets. So we generally have markets going up in the last couple of weeks of December, even if the macro is negative. And it generally happens in low turnover as well because most people are away. So, I mean, I think the trend is mainly driven for US markets. We get some of that coming through. So that's generally how it plays out the last couple of weeks, short weeks, but the market tends to grind higher.
Okay, you mentioned the US, a bit of news coming out of the States overnight. GDP at 4.3%. That's better than expected. A lot of it, though, is this data is backward looking, as we know with GDP, but it was also delayed because of the US government shutdown. Still, can you run us through what you think is your assessment of the US economy and the implication for interest rates, given the market is pricing in 2 to 3 cuts? This data was good for the share market because the share market there still rose. Technically, you know, if there's good economic data, it doesn't necessarily mean we'll get rate cuts. But also Donald Trump said, hey, just because we've got this good data, we should still see rate cuts, right?
Yeah, it is a reality show. Where can I start? Look, the data kind of was what we expected. It's big and it's positive data, mainly because the underlying data is actually quite negative. So the main reason we had a big GDP growth number is consumer spending. And that's not really supported by disposable income. So the real disposable income literally had no growth. It has zero growth. So spending has gone up mainly because this is forced spending. So things like healthcare, it has gone up dramatically and they don't have a choice. And naturally, it's being funded by debt. So it's probably not what you want to see when bond yields are going up. So they're borrowing to pay for their standard expenses. So that's where the big numbers were coming from. The other side of it is we're seeing imports falling. So the demand for goods is less because tariffs have put up prices. So people are buying less stuff that are made outside US. So in that context, we're seeing weaker consumer, which is kind of expected given that unemployment rate has climbed to 4-year highs. So I think the problem for the US is there's a lot of the data looks good because the underlying data is actually bad. And then the delayed effect of some of these shutdown data, like for example, the inflation data was missing all the things that went up. And those kind of things are creating a bit of a murkiness in the data set. So we got core PCE came out as well, which climbed to 2.9%. So the Fed that's their preferred inflation measure. They want to keep it around 2%. At 2.9%, that kind of asks the question of how's the rate cut? So this is where it gets tricky. The Fed chair flagged one rate cut per year. The market, because it's at 25-year high multiple, they need to have 2 to 3 at least. It probably needs more. But so they have to be optimistic at this point because if you say that there's only one rate cut coming, the multiples are not supported here. So the market is kind of caught between the two sides. And I think market has to remain optimistic, but the underlying data suggests the economy continues to weaken and the consumers continue to weaken. So that's a negative sign. So we're very cautious on US economy.
Still, though, like you mentioned, no matter what you think, it appears the market wants to see those rate cuts. We're seeing the softer US dollar. So the Aussie broke through 67 US today. We're seeing gold, silver all hit another record. How is this all flowing through to markets?
Yeah, look, it's to a certain extent we kind of expected it. So we've been our dominant exposure. We've been long is gold exposure. We've been in a lot of gold, Aussie gold miners, because by definition, the Aussie spot gold is now 6,700. So most of those miners, their all-in sustainable cost is below 2,500. So they're printing cash at the moment. And so a lot of the mining stocks are doing quite well because weaker US dollar tends to support higher commodity prices. But it's fascinating. You've got inflation rising around the world, even in the US. You've got copper at all-time high. You've got precious metals all running to all-time high. And then you look at construction costs are going up, and then you look at how that's going to play out into the inflation number. And you can only assume that inflation is going to rise over time if it's not already rising because the data is lagging. So in that context, yeah, it's going to be tough to see how the Fed plays through this. The bond market's not helping them because the bond market is just ignoring them. Bond yields is going up. So the Fed has cut 175 basis points from the peak, and the bond yields are higher. So yeah, that hasn't happened in 50 years. So it's fascinating.
So how does that make you feel as an investor, especially when you look back at the past year? I mean, was it a successful one?
We've actually done pretty well. And our thematic, and I think I've said this plenty of times before, we've just been long inflation sectors. So we've been long gold, we've been long food, we've been long energy. And we've had a lot of defensive stocks to couple with that. And those kind of thematics have actually worked really well. So our models are up somewhere between 30 to 50% over the year, and they've done really well. And it's heavily run by defensives and I guess inflation commodities. So we haven't changed our thematic. We still remain the same. We still think inflation is going to go up. We still think inflation-linked sectors will continue to do well. The supply side disruptions for a lot of those commodities are still there. And then the defensives, as the market goes up higher and higher, the investors are then selling the winners and diversifying into the defensives. And the defensives are now getting beaten up. So I don't see anything changing in the short term. I think the macro is still risky on global growth. I think global growth is slowing down, and the market is still trying to wait for something to happen to change the dynamic, because everyone knows the market is expensive. Everyone knows growth is in trouble. And the US continues to come up with so many distraction policies that people don't know what is real and what is not. So at some point, the reality will come through in the economy. And so you just want to be positioned for that. I think it's almost impossible to invest week to week.
So finally then, I mean, you can't invest week to week, but what are you telling your clients in right now? And how are you positioning yourself? Where are the opportunities that you're likely to see in 2026? And what do you think will be the key themes?
I think it's going to be quite volatile. I think 2026, I mean, if you think 2025 was entertaining, 2026 is going to be really entertaining. I think month to month, there's going to be a lot of volatility. And I think that'll open up opportunities. I think you have to think probably 6 to 12 months forward and say, look, when those opportunities come up in particular sectors, you need to take a longer term view and take a position and willing to sit through the volatility. I think it's going to be really hard if you cannot handle volatility. I think the underlying thematic is still going to be rising inflation. I think central banks have lost control. I think the debt will continue to grow. I think precious metals, I know it's at sky high. Nobody would have believed this a couple of years ago, but I still think they can go higher because there is no answer to any of these things. So, and the politics of it is take the easy way out. They're not going to really do anything. They're just going to let it go worse till something breaks, because then just blame the market. So in the short term, I think hold on and expect more volatility. I think the thematic has been ride the inflation cycle. and diversify your portfolio, manage your risk. But yeah, I don't expect it to be smooth. I expect it to be quite volatile.
It's Mathan Somasundram there from Deep Data Analytics, and he wraps up the podcast for this Wednesday and for this shortened trading week. Don't forget, if you enjoy it, give it a rating or review on Apple Podcasts and Spotify. Click subscribe, and I will see you back on Monday. This SBS on the Money Markets podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.